Aliko Dangote did not build an empire by chasing more deals. He built it by doing something much simpler and much harder. Each time one business threw off cash, he pushed that cash into the next choke point in the chain. Trading led to transport. Transport led to storage. Storage led to production. So the real question is not just how he got rich. It is why this loop kept getting stronger with scale, and why the same logic shows up inside many of the best companies in the S&P 500. Once you see the pattern, growth stops looking random. Most people look at wealth as a pile. Dangote looked at it as a flow. That difference sounds small, but it changes everything, because a pile invites protection while a flow invites direction, and the money that just sits still rarely turns into something larger on its own. He started in trading. That part gets told a lot, but the deeper point is what trading gave him. It gave him movement. Goods moved. Cash came back. Then he did not stop at the first profit and admire the result. He took the cash and asked a harder question. Where in this chain am I still depending on someone else? That is the start of capital recycling. You pull cash out of one part of the system and feed it into the next part that can remove friction, lift margins, or give you more control. So instead of spending profits like proof that you won, you treat profits like fuel for the next machine. Think about how different that is from the way most small investors act. A lot of people save cash and feel smart because cash looks calm. The balance stays the same. Nothing seems broken. But stillness can trick you, because money that does not move into productive assets often loses strength in slow, quiet ways, while better businesses keep compounding in the background. That is the hidden cost. You may not see a sharp drop, but buying power can fade, opportunity can pass, and the habit of waiting can start to feel like discipline even when it is really delay. If your capital never leaves the parking lot, it never gets the chance to build the road. Dangote worked the other way. He kept using one asset to unlock the next one. If distribution created cash, that cash could support logistics. If logistics improved reliability, that could support manufacturing. And once manufacturing entered the picture, the economics changed again, because margins that once leaked out to suppliers could stay inside the system. This is where vertical integration starts to matter. A lot of people hear that phrase and think of size, but size is only the result. What matters first is control. When you own more of the chain, you cut delays, lower dependence, and keep more of the value that used to go to outside firms. In plain terms, the business gets stronger because fewer parts of the outcome sit in someone else's hands. Now bring that back to investing. Cash has a job. It gives you flexibility. It lets you act when prices break. It helps you handle short-term needs without forced sales. That matters. But cash is not the finish line. It is optionality, not the engine. So the lesson is not never hold cash. The lesson is never confuse storage with growth. Dangote did not let capital rest once it proved it could move. And that is the same discipline you see in elite companies that keep taking cash from one strong unit and reinvesting it into the next advantage. Once you see capital as a flow, the next step gets practical. You stop asking where money can sit, and you start asking where money can work. That is the same shift Dangote kept making. He did not just pile up profit. He moved profit into the next part of the chain that could return more control, more output, and more cash. That same filter shows up in many top companies inside the S&P 500. The sectors differ, the products differ, and the scale is far larger, but the logic stays close to the same. Cash from one strong unit gets pushed into the next edge, and over time that loop builds a system that is harder to disrupt. Start with energy, because energy sits near the base of the real economy. If a company controls production, transport, refining, storage, or distribution, it is not depending on hype. It is tied to physical demand. And when that company keeps reinvesting cash into better assets, tighter operations, or more capacity, the business can protect margins in ways a weaker operator cannot. That matters because energy is not only about price swings. It is also about infrastructure. A firm that owns more of its chain can smooth supply, reduce outside dependence, and keep more value inside the business. That is vertical integration in practice, And it looks a lot like the move Dangote kept making as he climbed from trade into production. Now move to industrials and infrastructure. This is where the pattern gets even easier to spot. Some companies build machines. Some move freight. Some supply parts, systems, or services that other businesses need every day. These are not glamour stories. They are work businesses, and work businesses can get stronger each time management takes cash from one steady operation and feeds it into the next bottleneck. Think about a transport company that invests in better networks, or an industrial firm that expands into parts, maintenance, or logistics instead of relying on outsiders for every step. That is not growth for show. That is growth through control. Costs can fall, timing can improve, and the customer relationship can get stronger because more of the outcome lives inside one system. Then you get to tech, and this is where people often lose the thread. They hear tech and picture speculation, high multiples, and story stocks. But the strongest tech businesses do not run on hope alone. They run on systems, contracts, recurring demand, and scale. When a profitable tech company takes cash from one product line and builds the next layer of software, infrastructure, or service around it, that is also capital recycling. So even though energy, industrials, and large-scale tech look very different on the surface, they share the same engine. They generate cash. They reinvest that cash into the next advantage. Then the next advantage throws off even more cash. That loop is simple, but it is hard to stop once management gets it right. This also explains why broad exposure is useful but not always enough. A plain index gives you access to many strong businesses, and that can work very well. But when you want to think like serious capital, you need to notice where reinvestment is turning into deeper control, because that is where a company can separate from the field over a full cycle. So what does that mean for you? Keep cash for short-term needs, for calm, and for flexibility. Then look at your long-term capital through a different lens. Ask which businesses or sectors are using cash to build stronger systems, not just prettier reports. Ask where reinvestment removes friction. Ask where control keeps expanding. That is the Dangote system in plain terms. Profit is not the trophy. Profit is the raw material for the next move. Cash can protect you for a season, but systems build wealth across cycles. Dangote kept turning one stream of cash into the next layer of control. And many great companies still grow the same way. If you want more breakdowns like this, subscribe and tell me in the comments which business you think recycles capital best right now.